Is AI changing how big tech is valued? Yes. The data center build-out is turning into a bond market story. As companies scale AI capacity, they are moving from cash-funded projects to bond-financed infrastructure, and that makes interest rates a bigger driver of both stocks and credit. Here's the context. AI data centers demand huge upfront spending with paybacks stretched over years. When policy rates sit in the mid-5% range, the cost of capital sets the hurdle for every new rack, chip, and substation. That cost doesn't just hit the income statement. It reshapes how investors think about earnings visibility, valuation multiples, and portfolio mix across equities, ETFs, and corporate bonds. The mechanics are simple but powerful. More capex is being supported by debt to preserve liquidity, so interest expense becomes a bigger swing factor in net income. The choice of maturity matters again. Whether a company issues 3-year, 10-year, or even longer bonds changes both the coupon today and the refinancing risk tomorrow. Equity sensitivity to rates rises too, because growth models now must include explicit borrowing costs and potential leverage. Management playbooks are tilting toward multi-year infrastructure pipelines rather than buybacks, which changes how guidance is read and how cash is prioritized. A few numbers bring this to life. With a policy range around 5.25% to 5.50%, the starting point for borrowing costs is far above the sub-2% era. Issue $10 billion at a 5% coupon, and that's roughly $500 million in annual interest expense. A shift of 1 percentage point up or down moves that by about $100 million per year, enough to influence EPS paths and multiples. Data center assets are often depreciated over 15 to 20 years, so locking in favorable long-dated financing can lift returns across cycles, and mistiming can hurt them. What does this mean for investors? Track the rate cycle and the shape of the Treasury curve alongside earnings calls. Watch bond issuance, maturity mix, and stated capex plans as closely as headline AI metrics. Stress test valuations with higher interest costs and slower buyback support. If you own sector ETFs, remember they now embed more interest rate exposure through their top holdings. And if you own corporate bonds, follow spreads and leverage trends as AI spending ramps. The practical takeaway is clear. In the AI era, tech is relinked to rates. Make interest costs, duration choices, and capex pipelines part of your core thesis, not an afterthought. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.